Why I don't invest in real estate and why you should think twice. Whenever someone starts earning money, they hear the same advice: buy a house, buy land, real estate never fails. But is that really true? Today, I am going to share my personal views on real estate investing. This is not a financial advice. This is simply why I choose not to make real estate the core of my investing strategy. Real estate requires huge capital. Unlike stocks, you cannot buy a tiny piece of a house. Most properties require large down payments, home loans, registration charges, stamp duty, brokerage. Money gets locked from day one itself. Debt becomes part of the investment. You will not buy a house with cash, you will borrow. This simply means you are not only buying a house, you are committing to years of interest payments. Poor liquidity. If you need cash tomorrow, selling a stock can take minutes, but selling a property can take weeks or months or even longer. A good investment should be reasonably easy to exit. Rental returns are low. Many residential properties generate a rental yield of only 2 to 4% annually before expenses, depending on the market. After maintenance, taxes, repairs, vacancies, the effective returns may be even more lower. That does not automatically make real estate bad, but rental income alone may not justify the investment. Ongoing expenses never stop. Owning a property means you are paying for maintenance, repairs, property taxes, society charges, insurance. These costs continue whether the price of real estate rise or not. Concentration risk. Suppose you have 1 crore. In stocks, you can diversify across many companies and sectors. But in property, you can buy only 1 or 2 properties. And if the local market performs bad, then your major part of the wealth will be affected. Price growth is not guaranteed. Many of you believe that the prices of properties only goes up, but history shows that is not always true. Some properties can do well, but others will remain flat for years. Return depends on factors like local demand, infrastructure, employment growth, regulation. Hidden risk. Real estate can involve legal disputes, title issues, delayed projects, tenant problem, vacancy periods. These risks require time and efforts to manage. Opportunity cost. Money tied up in the real estate cannot be invested elsewhere. Suppose if quality businesses are available at attractive prices, you will miss those opportunities because your capital is already locked up. Why I prefer stocks? When I buy shares of a strong company, I own a part of the business. Professional management runs the company. I don't fix leaking roofs and find tenants. I can diversify more easily. I can invest gradually every month. I can sell quickly if needed. For my investing style, this suits me much better. Is real estate always bad? No. Real estate can make sense if you buy a home to live in. You understand the local market. You have a long-term plan. You avoid excess debt. The property has attractive cash flow or strategic value. The point is that properties are always not a poor investment. It is not a great one for me. My personal philosophy: I would rather own an excellent business than spend most of my wealth on one property. Businesses can innovate, expand, increase profit over time, and that is where I would choose my investment. Real estate has created wealth for many people. Stocks has also created wealth for many people. The important question is not which investment is popular. The better question is which investment matches your goal, risk tolerance, knowledge, and financial situation. For me, the answer is high quality business at sensible prices. If you found this perspective useful, hit the like button, subscribe to Anthony DeMello Invest, and let me know in the comments, would you own 10 businesses or one property?